when you're ready.
We'll make it work.
Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Paul Andreola. He's the founder and editor at Smallcap Discoveries, and he's currently number one in the microcap club. We're going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Paul. How are you?
Tobias, I'm doing great. Doing great.
Congratulations, first of all, on climbing to the top of those rankings. The last person I had on was Marge Sway Dan,
Yeah.
and before I got him on, you'd already taken his place. So I always have to ask you to start. Are you still number one?
I am. I think I maintained it for a couple months here, so we'll see. You'll probably have a new guest next month. We'll have to see.
It's highly competitive. It seems to
It
turn around
is.
pretty regularly.
It is. Yeah. Well, that's the nature of the microcap business, right? What is it? Penthouse one time and outhouse the next time, right?
Yeah, that's value investing. Been in the outhouse for a long time. I haven't been to the penthouse for quite a long time.
You'll get there. Just keep hanging on. Yeah.
It happened like like more than a decade ago now, but it's been a long time between drinks for deep value guys. So tell me a little bit about small cap discoveries.
What we have is it's a hybrid between a newsletter and a bit of an investors club. What we do is we're trying to find those anomalies in the microcap, I'd even say nanocap market. What we try to do is really find these odd little companies based solely in Canada. Right now, all we do is we look for sort of scrounge around the Canadian public markets and try to find companies that fit the criteria that I sort of used over the last 25, 30 years in finding these, they call them 10 baggers, 100 baggers, whatever you want to call them. Companies that typically go undiscovered for years, and then for whatever reason, something starts to happen. They become discovered, and with a little bit of luck, they turn into, pretty good investment wins.
So what are you looking for?
So a number of things. We sort of use a bit of the GARP principle, where we're trying to find growth companies, but really at early stages. So right at some form of inflection point. One of the key things we look for is companies that are growing at least 25% per year or greater from a revenue basis and on a per share basis, which is important. So we're trying to find these hyper growth companies that actually have some real fundamentals behind them, profitability, or at least some real visibility to profitability. And we're trying to find them before sort of the industry or the market finds them. So we've got this sort of checklist that we use that we sort of ideally a company will check off most of the boxes, and if it does, and we're fortunate enough to hold on to some of these, they turn out to be pretty significant winners.
What's on your checklist?
Well, like I said, revenue growth is the first thing we screen for.
Over what period
Profitability.
of time? Just before you, over what kind of three, five
Well,
years or?
yeah. So the more the better. Typically, we're measuring year over year. So if we see a company come out with a quarterly statement that shows their revenues have grown 50% over the same period last year, that starts to get us interested. Over and above that, if it's been doing that for several years and all the other sort of criteria still fits our list, then that gets us even more excited. So a good example, and one that has really worked out for us, was a company called Expel Technologies, which had actually had probably 8 or 9 quarters of just fantastic growth, and yet the stock had never really gone anywhere. So we were fortunate enough to capture that early enough where it had these back-to-back quarters, and literally turned out to be a 100 bagger from where we started buying it.
Oh, that's amazing. I think I've had a few small and micro cap guys. I think Connor Haley also had a position in Expel. So when did you
Mhm.
when did you discover that, and how did that play out?
So I discovered it when it was roughly about 17 to 20 cents. I think now, last I looked at it, and I've since sold it, but I think it's trading around $15 or $16.
Wow.
That would have been 5 years ago. I can't remember exactly when, but it was early on for sure.
Is that a Canadian company? Are you looking at you're exclusively Canadian?
Well, exclusively Canadian listed. So Expel actually used to be listed in Canada. There's a number of companies down in the States that'll come up here and list because of the structure of the sort of the IPO market here. So that was one headquartered in San Antonio, Texas, but listed here, had sort of toiled in obscurity up here for years, and it just kept growing its business and then eventually left the Canadian market. And now it's exclusively trading down in the States.
So they can be US companies and they're taking advantage of that lower listing standards. Are they going onto the Toronto Venture or something like that, or are they on the main board?
Yeah, so the TSX Venture, is the Toronto Stock Exchange Venture sort of component. I would argue actually that the listing requirements themselves are about as onerous as any in the world. It's just the sort of the way the industry is set up here. I think it's more conducive to funding like very, very early stage companies. And I think that was the big draw for a while. But yeah, it's they're scrutinized the same as any other company. The TSX Venture is, I think, what you're asking. That's right.
So the idea is that rather than raising venture capital, say you go and you can get a more distributed shareholder base by listing in Canada. I'm familiar with that a little bit because it's a similar process in Australia. I think they can get listed. They tend to list at an earlier stage. There's a less mature maybe venture capital market there, so they tend to list at an earlier stage.
You're dead right. That's exactly it. So I've often said that I've actually worked with the TSX Venture Exchange and doing a lot of road shows to try to entice companies to come up here and list. And that's just it. They're really, an early stage company's got a couple options, and one is, venture capital. I think what's happening now more with venture capital is they're looking for the next unicorn. So it's less likely you're less likely to get funding from one of these big VCs. And if you don't meet that benchmark, you're sort of left to struggle and try to find, angel investors. And the TSX Venture Exchange is sort of that, secondary option. That being said as well, the venture capital market in Canada up until a few years ago, I would have said is extremely immature, not really able to properly fund a lot of these companies. So the TSX Venture was really the only option, especially for a Canadian listed company to get any kind of capital that they really needed. Yeah.
And that venture capital money, there's a lot of fish hooks in it that you got to grow at a really rapid rate to hold on to your equity in those when you take that on.
Well, that's true. And the other issue too is if you have any sort of stumble, that's when it gets really dangerous. Where if you're publicly listed, you've got sunk capital, and it's typically distributed capital. So there's not one person or one group that says, okay, because you didn't hit your benchmarks this quarter, you're gonna you're ratcheting back. Exactly. So there's some real viable reasons why it makes a lot of sense for some of these startup companies.
So what's your background? You've been doing this for 2 or 3 decades, you said. What were you doing before you were writing the newsletter? How long have you been writing the newsletter?
The newsletter itself, I think it's about 8 or 9 years. Prior to that, I mean, I've got no formal education in the investment arena. I studied construction management back in the early 20s, but I'd always had a passion for investing. I bought my first piece of real estate, I think when I was 18, 19 years old. I bought my first stock, I think I was 19 years old, but no formal background there. It really was a trial by fire, or school of hard knocks. That being said, I actually worked in the construction industry for about 7 or 8 years. Found that I really hated it, so went to sort of my back to my hobby, which was investing. Probably when I was 17, 18 years old, I pretty well read every book you can imagine that was available at the time on investing. and started dabbling and doing okay. Nothing crazy, but really learning early, some of the issues. And then what happened was, 8 years into construction and just breaking my back and sort of hating getting up in the morning to go to work. My wife at the time had said, look, you're miserable. You find something else to do. So what I decided to do is I quit my job, and I, at the time, the internet was finally out there, and I started, I wouldn't say day trading, but I started investing and using some of the tools that I'd learned from different books. And there were certain books that really stood out for me. Started using those tools and started investing on my own. And then there's a couple events that sort of triggered some real changes in what I was doing. And most of them were books. I remember reading William O'Neill's How to Make Money in Stocks.
Is that CanSlim?
CanSlim, exactly, CanSlim. Prior to that, I'd be going, down the library. I'd try to, review company filings and not having a clue what I was doing, really. I was just trying to find companies and investing in some idea that I thought just sounded good. But when, as a matter of fact, the reason I even found out about CanSlim was I'd entered a stock picking contest, and there was probably easily 1,000 people that are in this contest, and I think the prize was $100,000 portfolio. This bank-owned brokerage firm was going to give whoever the winner was $100,000. So of course that was incentive for me to jump in there. I think over the course of the 6 months, because relatively short contest, over 6 months, I came in like 56th or something like that out of 1,000, which I thought was impressive. But the guy who came in first just blew everybody out of the water. Like second place wasn't even close. So they interviewed him, and he said, "No, I had a little strategy." And they said, "What's the strategy?" And he said, "Well, literally all I did was I bought whatever stock was hitting a 52-week high, and it was trading close to $1." And then they would ask him, "And then what?" And he goes, "No, that was it. That was it." Right? And I go, "What? I mean, I did all this hard work and I studied and did this and this, that." And then the guy said, "Well, it was based on a principle that he learned out of CanSlim, which if you know CanSlim, the 52-week high is a critical component," which blew my mind, because it was always, for me, it was prior to that, it was, you're going to buy something cheap, right? You don't go and buy something expensive, just doesn't make any sense. So I read the book. I probably read it over 3 or 4 times, and I said, "Okay, well, this sounds crazy, but I'm going to try it," right? And lo and behold, I started trying it, and the performance of my portfolio just went crazy. It literally went from maybe averaging 10 to 15% a year to like 100%, 120%, right? So I go, okay, something's going on here. But because I was, I'm based in Canada. Basically, I've studied the Canadian market. I tried to tailor it a little bit to the Canadian market. There's some nuances in Canada. It's a little bit different in the U.S. Stocks typically trade at a lower sort of price point. There's different stock structures. There's not as many microcap funds, things like that. So I started to understand the industry a little bit more and started to sort of formulate CanSlim to more of a Canadian model. And when I did that, my performance really went crazy. But at the time, so I'm working at home. I've got a small portfolio. I'm starting to grow this portfolio, and my dad, who is so anti-stock market, it was crazy, and he was convinced. I'd left my 9-to-5 job and had started trading stocks or gambling. Well, he thought it was just full of sharks and crooks and you name it, which it is, but I was making money, and he couldn't believe it. So he said, "Well, listen, I'll give you $10,000. Do that for me." And I did, and he started making money. So the next thing that happens is he's telling his friends and other members of the family. And before I knew it, I had like 7 or 8 accounts that I was trading for. And the deal was I would get a percentage of whatever the winnings were, right? So I started opening up more and more of these accounts at this brokerage firm and thinking, hey, this is great. I'm actually making money. And, the world's perfect. I get a phone call from the brokerage firm saying, it was their compliance department saying, what are you doing? Are you licensed to do this? Well, I said, no, of course I'm not licensed to do this. I'm doing this, on behalf of my family. They said, well, you can't do it if you're not licensed. So of course, next thing in my head was, I'm going to go get licensed. So I became a broker. And of course, once you're a broker, you can't get a percentage of the performance. So my income went from, way up here to way down here because I was just generating commission now. So that's kind of, and so I got into the brokerage business that way. As a matter of fact, I really struggled to even get in because they were only hiring people with MBAs. And I found a little, I'd almost say bucket shop now. It's not really around anymore. But they hired me because I phoned every day until they finally, got sick of me calling and had me join. And I joined the firm. And what was interesting is I had developed this sort of strategy that was working. And I'm this young guy coming into this, brokerage firm full of about 100 different brokers. And I used to think that the brokerage industry was this, this sort of gilded, doors. And, these are all the smart people. And these are the guys that, have studied this stuff and have a PhD in economics and you name it. I got in there and I was blown away how chaotic and unprofessional and how poorly it was crazy. I was actually the first person there to request financials. Like I would, at the time I was actually buying a lot of US stocks and I would go to my boss and say, hey, look, I need to find quarterly statements on this company. And they wouldn't know what to do. Like they had no idea what that meant. So at that time, this is how bad it was. If I wanted quarterly statements on a company in the US, they would have to send a request and wait for it to be mailed in. Like literally mailed a set of financials. So I moved heaven and earth. The internet was just, around at the time. And I moved heaven and earth to finally get an internet connection to the firm. And this way I could access financial statements over the internet. And slowly, surely, what started to happen is as I was doing this and I was finding these little companies, and this is at the early stage of the tech boom, I'd say early 90s for sure. Others around me started to see what I was doing. And before you knew it, as soon as I would go and place an order, because at the time you'd have to go and run an order into the desk, and I would see my order get placed, and immediately right after that, there'd be a bunch of other orders coming in from my firm. So somebody was sort of, tailing me on everything I was doing. Over time, I got a bit of a reputation for having found these weird companies, but the performance we were generating was astronomical. It was I can easily count in the hundreds how many stocks that we were buying that were going up 4 or 5 times in value over the course of a year. It was crazy. Yeah.
So what is CanSlim's? What are the rules of CanSlim, and how did you modify them for Canada?
So I can't remember them all because it's been a while since I've read the book. But you're looking at things like stocks hitting a 52 high is a real big deal there. You want to buy hyper growth, so the 25% growth or higher, both in revenues and earnings. You want to look for new things, new management, new products, new territories, new something. You want to buy, CanSlim, they want to see very low institutional ownership. That was something that was really novel to me. Same thing up in Canada. And there's a few others, but the other ones I'd say are almost not as important. So in Canada, one of the big ones for CanSlim was you don't buy anything less than $10. Well, in Canada at the time, there were probably only a dozen stocks that were trading over $10. And I'm being a little sarcastic here, but so that was one of the big modifications is any price. For me, it was regardless of price, if it met the other criteria, you're jumping on. There's no institutional ownership in Canada at that time until the stocks were getting into the sort of $100 million market cap and higher. But I was looking at everything sub 50 million. So it little nuances like that. So I didn't care if there's institutional ownership at all. More times than not, there wasn't. The price was the big one. I would look at a stock if it was at 50 cents. That didn't bother me at all. They were looking for volume. It's criteria. That was something that I didn't care about at all. The more illiquid, the better. So it's just those kind of modifications. It wasn't dramatic, but it was things that are just a little bit more tailored at the Canadian side.
Is the idea behind the absence of institutional ownership that they will buy in the future, so you're kind of front running the institution?
That's exactly it. So one of the benefits I had from being a broker was actually understanding the industry more than in any sort of tips on how to buy stocks. It was really understanding what motivates every component of sort of the brokerage or institutional industry. And the biggest criteria when it comes to a lot of these funds is the size of the company. So if they're managing $1 billion, it's very unlikely you're going to be buying a sub $50 million market cap, because the numbers just don't match up to make it worth their while. So what I noticed while I was doing a lot of buying in the space was that these companies would sort of grow at a certain pace, and there'd be very little interest until it just hit a certain market cap. And to this day, it's still a little bit like that. You see the $50 million point and $100 million point, and as you go higher, you just see these different levels. And what I was noticing is this: as soon as a certain company met a certain market cap, you'd see a bunch of buying, you'd see a bunch of volume, and the change in the sort of activity around the stock, it was just so obvious. And then I was finding out, well, what was happening was it was hitting that criteria that some of these sort of microcap funds were able to buy, and they would buy because there was so few things they could buy. And you see this just rocket ship in share price, where you all of a sudden you go from, you toil between 20 cents and $1, and then at $1 it goes like straight up to $3. And you're going, whoa, okay. So I kept thinking, I just want to be a couple of steps, in front of that, and that's what we started doing, and it worked like a charm.
I'm a little bit familiar with the share price idea as well, because in Australia the listing price minimum is 20 cents, I think, and it's like if you come out at $1, you're really making a big statement about what you think your company's. It's silly because you can set it anywhere. Yeah. So what's the minimum listing price in Canada, and what's the minimum listing price in Canada?
Yeah, so technically, 5 cents. 5 cents would be the minimum listing price. You don't really see too many companies get listed at 5 cents. You're going to see most of them somewhere between 20 cents and $1 when they get listed here. The TSX exchange was sort of the senior exchange in Canada. That's a little bit different animal, and there's not really a price requirement like there is on NASDAQ or some of the other exchanges, but there is there is certain tiers, and it almost depends on how frothy the market is. If the market's really frothy, we've seen the bubble in sort of marijuana and blockchain and things like that. You tend to see the price get IPO prices a little bit higher. When things are really slow, you're going to see them lower, but ultimately it's all about market cap, right?
So you invest publicly and privately?
So yeah, I've done a fair bit in the private space. I'm kind of agnostic. Really, what I'm looking for is a certain criterion company, and of course price. What I've found over the last little while, quite frankly, is that I'm finding cheaper valuations in the public markets than I am in the private market. So if that's going to continue, I'm going to predominantly be investing in the public market. But we've been involved in helping some companies go public that have sort of the criteria we look for. And when the public, when it's flipped around the other way, it's a great opportunity for arbitrage. You're finding a company that's growing at say 25% a year, and it's got a valuation of 5 times earnings. The market tends to give you almost at a minimum 10 times earnings. So there's an arbitrage there, right? So we were seeing opportunities a few years ago where literally all you had to do is you take one of these private market valuations, you take it public, and there's your arbitrage. You're making money. But it's this weird dynamic right now where it's flipped around because of this crazy VC private money. You're starting to see actually private equity coming into the microcap space because they're finding better deals in here, and I'm seeing it. So, yeah.
Do you? So you're investing with a view to an IPO? Is that the idea?
Yeah. So everything is still sort of levered off the public markets. When I say I and we, I sort of interchange it. We've got a bit of a network of investors now that kind of follow what we do or do what we do, and we try to spread as much sort of opportunity around as we can. But we know the effort that it takes to take a company public, and what you sort of need to make it all work. If we can bring that to the table, we will. Otherwise, I prefer investing in already public companies. Yeah.
Can you talk about, you've got two, MDUTV and Destiny Media. Can you talk about those two companies? Sure.
So those are the two I'm willing to admit about. There's there's another private company that I was involved with that I'd almost say was a disaster, but it had a lot to do with timing. So MDUTV, it was a startup actually. So after I was in the brokerage business, I actually got tired of the business because I love my clients, but I hated having clients. It was a weird circumstance. My personal portfolio was making me more money than my day-to-day job of being a broker. So I finally said, okay, this is not making a lot of sense. Plus, I was getting just a little tired of the day-to-day and the issues around being a broker. So I was asked to help on a startup. So I left. I decided to leave the business, and my job was basically raise money because I'd been in the business. I was going to raise money for this little startup, and what we were doing at the time was it was really the advent of satellite television as a replacement for cable TV in urban areas, right? So it predominantly satellite TV was going to be for rural areas. But we had a business model where we can come into a high rise or a large sort of residential complex and cable the unit for satellite TV and turn it into a mini cable franchise. So we did that, and in Canada the cable franchises were so dominant, and there was like the most hated companies in Canada were cable companies. And we had, we had this idea that we're going to sort of displace some of that business, and we set to do that. So we raised a bit of money privately, and started our business. And then we were approached by someone, and it wasn't me, but somebody else approached and said, "Well, why don't you go public?" And we said, "Okay, well, let's go public." And it was just before the .com or the tech boom, and it just caught fire. It was a little company that we started. I think we took it public at 25 cents, and like within a year, the stock's at $10.
Wow.
And but mind you, the business was growing. I mean, I remember still sitting across from the founder at my kitchen table, and we had actually sketched out the business plan. So there's no employees. We went from 0 employees to 150 employees in probably a year and a half. The business just exploded. But it was also kind of pre-internet days. So I was fortunate because I was able to see all the dynamics around almost like a mini unicorn, where we went from 0 to 100 miles an hour in no time, and got all the benefits of that. Management sort of took over. I was really redundant very quickly because they'd raised money, and my expertise was pretty well useless at that point. So I left that business and did very well by it, and then started another company called Destiny, again with a couple founders. My role was to help them raise money and sort of steward them around. But this time our eyes was really on going public as quick as we could, which we did. And back in those days, my gosh, we'd still argue that we had the first streaming software platform in the world. The founder had actually sent a version of this the founder used to work at Electronic Arts, and him and his partner had developed this ability to play video games with each other remotely and be able to speak to each other while they're doing this. This was unheard of at the time. So we took this little bit of software and we said, well, we're going to change the world, right? We're going to be able to broadcast radio and TV and everything. And he came up with the idea that he would send a version of Microsoft to see if Microsoft had any interest. And he's actually, I think he still has it, but he's got a framed letter from one of the engineers at Microsoft saying, this is impossible. It's not possible to stream audio over the internet, right? Of course, about 6 months later, Microsoft comes out, Real Networks comes out, and that business goes absolutely crazy. These guys are, we were left in the dust. But fortunately, we were sort of pivoted, like good startups do. And the company's still around, but boy, we were at the heyday of sort of streaming business, and with a little bit of luck, it would have been a lot different.
Where's the stock price now?
I think about $1. It probably gotten up to the equivalent of $20. I don't even know if it's. I left it a long time ago as well. I went on to greener pastures. I think I've got a attention span disorder or whatever. 2 to 5 years is about all I could last. So, yeah, great story. So those are the two successes that I like to talk about. I learned a lot from. That's probably the biggest thing that's happened to me. But then there's a third one that I don't brag about, but it's just as educational. It was we had sort of put the band back together from the MDU days, and we had a different technology that would allow us to use the electrical system in a building as internet, sort of your internet network, and it was called Broadband over power line. And we put all the same sort of management pieces from MDU days, and we're going to go out and show the world how to properly do this. And that was 2007. So we had raised a whole bunch of money, and we needed to raise a whole bunch more. And of course, this little thing called the financial crisis hit, and basically went to zero overnight because we couldn't raise any more money, which we had to keep the business going.
Does the technology work?
Oh, it works great, but now there's better technology. Now you really want as much fiber as you can, and the issues around that technology, it's been improved so much with other technologies that it's pretty antiquated now. Yeah.
Yeah, that's very interesting. I've heard of that idea before, but I wasn't aware that was actually. I thought it was just one of those things that they used to raise money. I wasn't.
No, it works. It's amazing how fast technology advances, and you just don't know what's coming. But fiber at that time was, well, you're only going to lay fiber where you really need big traffic. You're not going to use it, close to the home. Of course, now we're seeing, as a matter of fact, another company I'm heavily invested in is doing fiber to the home. So there's, it changes so fast. That's one of the dangerous areas. You got to be on top of it. Otherwise, you can get blown up pretty quick.
I saw that a little bit in Australia. I worked in a telco that did dark fiber, and they were doing fiber to many times doing fiber to the node, and it was unnecessary to do it to the home because even though they were using twisted pair coax for most things, the technology on twisted was always getting better as well. So that was getting faster and faster. So it just wasn't necessary to run the fiber all the way into the home, which is clearly like exponentially more expensive than just running it to the node.
It is, but what's happening is now whoever owns that last mile of fiber actually owns that customer. So especially in the UK, you're seeing they're sort of tripping over themselves trying to deploy as much fiber right to the home, because once you've captured that, I mean, think of Netflix and everything that's going on right now. The amount of data that is being pummeled to the end consumer is massive, and it's growing so fast that the good thing about fiber is now if you're going to improve on the last mile, you want it sort of that highway built as big as you can already, and that's the advantage fiber has over. Fiber has other advantages over twisted pair, and some of it is just the maintenance cost is significantly lower. So there's all sorts of reasons, but yeah, all sorts of things. Exactly. Yeah.
Just let's go back to the way that you're investing now. What's your screening and search process? How are you finding these ideas? I saw in the note that you sent through to me, you read every single file. You read it. How many companies are listed in Canada?
Thousands. I've lost count of how many there are, but I mean, it sounds worse than it is. I've been doing it for so many years that I can see a name right off the bat and I'll know a fair deal about the company already. But what I do is I take myself a cup of coffee or a beer, it depends on how the day's going, And every day we've got CDAR. You guys, in the States it's Edgar, but CDAR is a repository of all the filings. So every day there's a set of CDAR filings. I'll review the financials that are posted that day. And I'm quickly scanning, right? So I open up the file, and I'll notice pretty quickly if it's, that 25% growth rate or not. And if it isn't, well, I'm on to the next one. So literally within 15 seconds, I can tell if I really even want to look any deeper. So that's what I do. I do that every day. Some days are heavier than other days, depending on time of the sort of quarter. And then a couple times a year, what I'll do is I'll just review all of them. And the beauty is, in this business, you don't need 100 investments. You got to find that one or two. And if you find them early enough, that's it. That's what I'm constantly looking for, is that one or two that just, fits the bill. Sometimes they don't quite fit all the criteria, so I'll put it on a watch list, and I'll keep following until a few things come to place. And then I'm off to the races. The one thing I'll note is that I hate, not that I hate, too strong a word, but I don't use any screening software. The reason why I do it manually is because every now and then I'm not always that crazy about the data that goes into these screening software packages, but every once in a while one falls through the cracks. And that's the one you want, right? So if you're going to find that one that falls through the cracks, you got to do the work to go and find it. And Expel was an example. Expel was a weird little circumstance where it was actually a Canadian listed company, but trading in US dollars. So it had a .u sort of suffix to the symbol. And for whatever reason, it just didn't screen well. It didn't screen in most screening packages. So that was a great example of if I was doing it like everybody else was doing it, I would have missed an absolute beauty.
So when you find an idea that's worth pursuing, how do you prove it up? How do you validate it?
So that's, a good question, because just finding the financial criteria sort of gets me started. Now, a lot of times what will happen is if it sort of meets the first 3 or 4 key pieces, I'll actually start buying it. And then I get a sense of liquidity. I get a sense of a little bit of market reaction. I'm not super keen on technicals, because so much of that with the liquid stocks can be influenced so easily. But I will start to go through another set of process or sort of due diligence process. And that's where sort of my experience in the industry comes to bear. So I'll look at things like, share structure, who owns the stock, how it was financed, who financed it, who are the significant shareholders. Then you look at things like how's management compensating themselves, how they've been with share rollbacks or share splits. There's a whole bunch of other factors, but they're not necessarily sort of quantitative. They're more qualitative. I'm going in and I'm always trying to find a reason not to own the stock now, right? And the nice thing about owning a little bit is I personally tend to do better due diligence once I own the stock than before I own it. So I want to, I'm now more motivated to really go and find, all the warts, because a lot of these microcaps have a lot of warts on them. And I'm just trying to find every little bit of information I can. And other things like, a lot of times I'll have already established a pretty big position before I even talk to management. When I do talk to management, some of the questions I ask are kind of, they find it odd, but I want to know how many people have called them, like how many investors call them, right? I've got this great story where I actually, I phoned this little tiny company and got the receptionist. And my question always is, hey, listen, I'd like to talk to whoever handles your investor relations, right? So she said, okay, hold a minute. And it probably took her 5 minutes to get back. And she came back and said, I have no idea what you're asking me. I have no idea who that would be. So that got me excited, right? I spoke with the CEO. And I've got another gentleman that I work with that was helping me out in due diligence here. And he called as well. And we both called. And we were like the first 2 people that called him in like 2 years. And he was convinced that we were actually his competitor, trying to find out about what he was doing. So when he finally found out that we weren't competitors and we were crazy little microcap investors, he really opened up, and it was kind of cool. But That's what gets us excited when you hear that you're the only one that's really looking at the company. Yeah.
So when you find something, you've proved it up, you like the opportunity, how do you think about sizing an initial position? How big do you want it to be in the portfolio? How many names have you got on at any one time? How do you think about that sort of stuff?
So I think I take a different approach than a lot of other investors. I really believe that if you're trying to create wealth, you have to be concentrated. If you want to preserve wealth, you have to be diversified. So I'm still in wealth creation mode. So I don't. There's no set number. That's kind of it. If I find something I really like and I continue to believe it's undervalued, and my modeling, my due diligence keeps proving that, I'll keep allocating capital to it until something happens. Either the model breaks down or the stock starts to go where it's supposed to. At any one time, I'd say my sort of the bulk of my portfolio is probably made up, between 5 and 8 names. But I might have a whole bunch of others that are sort of that small starter position where I'm just trying to see how much more capital they should sort of get. And it's the analogy I kind of use is like a sports team, a baseball or hockey team, where you want to keep your best players on the ice. You want to keep, give them as much, time on the field as you can. And but you also want to keep watching who is on the bench that's looking good. You want to replace them with. So one of my sell criteria has less to do with what an individual company is doing and more with what other opportunities are presenting themselves. So all that sort of stuff comes together and it dictates how I make up the portfolio. I've had circumstances where, one stock could be 60 to 70% of my portfolio, and it doesn't flinch me in the least because I truly have conviction in the business and the value, and prepared to prove it out.
How do you know when you've made a mistake, and what do you do in those circumstances?
I huddle up in the fetal position and cry myself to sleep. No, because it happens more times than not. It's to be expected, especially in the sort of part of the market where I'm at. You're going to have companies that completely just crap the bed. You have to almost price that in to everything you're doing to begin with. So more times than not, I know the company almost better than anybody else out there. So that's my advantage. I've got to see if there's some little headwind that's coming. I've got to see that in advance, and I've got to be prepared for that. So like anything, if I see something going wrong, I start to exit the position. And if I see things starting to turn around and right up again, then I might add to the position again. But look, if I'm wrong, I'm going to lose money. End of story. So I just try to see it as early as possible, and it sort of adjust the sales so that I can take it, and do what I need to do to get out of it.
Do you have any view on the strategy itself? I know you transition between private and public depending on sort of which is offering the better opportunity, but do you have a view on whether the strategy is getting played out?
So you asked about the strategy, kind of when it works and when it doesn't work. I noticed that it has, like, it's almost like it's cyclical. This works really well when there's not a bunch of other, I'll call them bubbles, right? This didn't work well in Canada. We had you guys have down the States as well, but the big marijuana, sort of craze for a while. It's a shiny object, right? All of a sudden, investors run from one thing that's working and run to the one that they think is working better, so they'll run off there. So the strategy, as far as the performance side of it, the strategy doesn't work well when a lot of other things are working because capital just goes to where it wants to go. But the buying opportunities present themselves better in those times. So you get those ebbs and flows all the time, right? There's always some new shiny object, so you've always got that. But what I've noticed over time, because I've been doing this for so long, it seemed a lot easier way back in the day because I guess it was a little more difficult to get access to information. I think now, almost any investor has the same tools I've got, so they can get out there and find out about these companies at the same time I can. So it's a little bit more competitive there. But yeah, so cyclical to some degree. I think it's working now. for me, it's not so much I'm trying to predict what's going to happen in the space or that. I really, it's a real bottoms up approach where I look at every individual company on its own and say, okay, it's either cheap or it's not cheap. I'm buying it if it's cheap. If it's not cheap, I'm not buying it. And it doesn't matter what's happening or where we are in the cycle. It's got to make sense. So I avoid market noise. I avoid trying to predict where the market's going. I have a very hard time trying to sort of pinpoint whether the market's too expensive or too cheap. Everything is really an individual case by case basis.
Do you have any preferred industries or sectors or anything that you avoid?
So yeah, things I avoid for sure. Like we stay out of the extraction business, so we don't do anything in mining or oil and gas or anything like that. We look for businesses that have some sort of repeatability. So we've invested in everything from engineered wood products, software, biotech. Biotech's a too strong a word because that tends to be a little bit too binary. Healthcare, a lot of healthcare stuff. But then we're finding is the best places are these obscure little, almost niche markets where there's no real industry. It's just some company is developing something so new that it doesn't have an industry. Expel is a great example. When I found it, I didn't even know this stuff existed. If you don't know Expel, they manufacture paint protection film for your car, right? The first time I saw it, I'd never heard of this stuff before. So what industry is that? It's, it's kind of in the auto industry, but, so anyways, it was bizarre. And now it's a semi-big niche industry. So I try not to get too caught up in what they do. I try to get more caught up in the numbers and have the numbers prove the business out.
Yeah, it's absolutely fascinating. If folks want to get in contact with you, Paul, what's the best way or follow along with what you're doing? How do they go about doing that?
Well, smallcapdiscoveries.com. That's our website. Really easiest way is just send me an email directly. They can send an email to Paul at smallcapdiscoveries.com. Send an email. I'd love to talk stock. I think that's one of the things that probably my wife, thinks I talk too much about. But if anybody's got any questions, especially any questions around the microcap space in Canada, there's very few things or few companies I don't at least have some knowledge about. But Paul at smallcap discoveries. I'm on Twitter. I think it's at Paul Andreola. That should be able to find me there. Yeah,
I'll link it up in the show notes. Yeah,
Perfect.
Absolutely fascinating discussion. Really appreciate the time. Paul Andreola, Small Cap Discoveries. Thank you very much.
Thank you. It was a lot of fun.
And we're clear, mate. That was so much fun. That was awesome.
That was great. I love it.
It's so funny. The last one I recorded was Cliff Asness from AQR, so it's just a total 180 from that, which is great.
It's heavy. It takes a lot to make the world go round, for sure.
Yeah, it's fun. Well, that's cool. Yeah, I really enjoyed that. That'll be a fun one. So it'll come out Monday week.
Okay, perfect. Yeah, just send me it and I'll fire it out to everyone I know as well.
And so we do the full podcast comes out kind of on a Sunday night. Then we put the YouTube video comes out on the Sunday night, and then on the Monday morning we blast it out through the email and through Twitter, and we just chop out interesting kind of exchanges and run that Tuesday, Wednesday, Thursday. So it should get some good exposure out of it. And
fantastic!
If you get any good opportunities or anything, let me know because it'll.
I will.
I always want to know.
Absolutely, no, it'd be great. Would love to sort of keep in contact and throw you ideas that might make sense.
That was cool. Well, thanks so much for the time. I really appreciate it.
I love it. No, appreciate it on my end as well. Thanks a lot, Tobias.
Thanks, Paul. See you then.
Okay, cheers.